Hello and good evening. You're welcome to day 5 of 31 days on investing education. And you're still welcome to my channel. That's Invest Blade TV with Kenny. We've been looking at a number of things. We've looked at different types of investment vehicles. We looked at 3 personality traits you should avoid when you're starting to invest. And today we want to look at 3 types or different types of investors. And first of all, let me define who an investor is. An investor is any person or other entity, such as a firm or mutual fund, who commits capital to the expectation of receiving financial returns. So you're committing capital to a firm, to an individual, because you are expecting return. That's a very big one. And different investors have different ways by which they invest. You can invest in mutual funds, you can invest in stocks and bonds and commodities, options, futures, foreign exchange, gold, silver, retirement plans, and real estate. We covered a number out of this in one of our previous episodes. You can check it out. I think we'll do one more just to, give you the full view of these investment vehicles. So let's stay tuned for that. And we're going to go on to talk about other types, different types of investors. All right. First of all, investors differ by the style they want to use or their risk tolerance. All right. For example, some investors would prefer to just invest in very low risk investment, and they are very conservative people. These are the people that do certificate of deposit, they go into bonds, treasury bills. So their approach is typically that I don't want to lose money. I don't know if you got that. So let's assume this person has $100. Remember, we're using $100 as the unit of analysis in this on this channel. So the person has $100. His goal is to make money above $100, but never, ever, ever lose that $100. So they are going to be very concerned about how the investment they're trying to get into preserves the money that they have. And somebody says, "Oh, why is it like that?" Many organizations that invest like this are investing on behalf of other people. For example, there are some very popular pension funds globally that this is how they invest, making sure that the pension contribution of people is never lost, and then any little amount they can make above that is just fine. So if they make 5% above that, that's great. If they make 10%, that's also perfect. So these are things to look at when we're talking about the kinds of investors that are very low risk. All right. Now, the other type of investor is an investor that is high risk. That is, they're open to more risk, and in economic terms, you will say they are less risk averse. So what that means is, hey, I don't mind taking a little bit more risk in order to make a larger profit. So they look at it on the downside, upside. So if this person is putting $100 into an investment and they say, you know what, this your $100 can yield $700. That's 7x, right? And you now know what? They say, well, you could also lose up to $70 out of your $100. The first type of investor we looked at, the low risk investor, would run away. But the high risk investor wouldn't mind at all. So depending on who you are, you should get your investment, your risk level in that way. All right. So let's also talk about institutional investors. Institutional investors are organizations such as financial firms or mutual funds. They build sizable portfolios in stocks and other financial instruments. They are able to accumulate a pool of money. People, subscribe to their mutual funds, and when that money is large enough, they invest on behalf of the individual investors. All right. So this way, they are able to charge a premium over how much is made annually. Of course, there are different schools of thought on this subject that, hey, how come you want to invest that kind of money on something that you will always have to pay 2.5% every year? And I know a number of analysis has gone into what that 2.5 translates to in the course of 20-25 years. It's not a small money at all. So these are things you also want to look at. Now let's talk about passive investors and active investors. So a passive investor is somebody who tries to hold uh, indexes, right? That is to say, this person is not buying, excuse me, is not buying one stock, all right, but they are buying an index, which is this. For example, you could buy S&P 500. That means I'm buying that share which has weighted a number of companies that are now in the S&P 500. So instead of buying one single share of maybe McDonald's plus Burger King plus Costco, for example, I'm choosing to buy an index that has comprised all of this together. So that's what some people do, and then they keep on shifting the weights around so that they don't want to have too much money of their company invested in one single stock. All right. Now, an active investor is somebody that is choosing to invest based on what they are able to analyze on the individual stock. These people could be called stock pickers. They study and do research and say, you know what, based on my research, my investment thesis is giving me the go ahead to invest in XYZ company. And some people have excelled in this while not many people have. But if you have an organization that can help you in this direction, I tell you, is something very beautiful that you can do. Now, talking about active investing, there are some people called value investors. These are people that look for stocks that have a low share price, or their share prices are low to their book value. So they almost live and die on the analysis of price to earnings ratio. So you can have a stock that is costing, let's say, $200 per share, for example, and its price to earning ratio maybe 3.0. What this means is that this price is just 3 times its earnings potential. That means it's relatively cheap compared to a share that is $50 per share, where its price to earning ratio is 70. That means you are buying 70 times the worth of the earning of that stock. It's an interesting metrics. And of course, some of the people that personalize, that have embodied the value investing, you have Ben Graham, the mentor of Warren Buffett. But in the contemporary days that we live in, Warren Buffett is the face of value investing. Now, there are other people called growth investors. What they look for is stocks that have long-term potential for growth, even if they may be losing money in the present. And there are many stocks that look like that. Maybe because they're building something, they're developing into other fields. It looks as if they're losing money in the present, but they have great potential for growth in the future. All right. Guess what? Passive investors that invest in ETFs, indexes, mutual funds, and all that have gone to exceed the active investors as at 2023. So the overall market sentiment globally now shows that many people are choosing to invest passively in some of these indexes because it's less risky, and this is something you want to look at as well. Now, let's go on to types of investors based on the kind of companies they choose to give money to. So let's talk about the angel investor. An angel investor is an high net worth individual who provides financial capital to a startup or an entrepreneur. These are people that they want to invest in the company even before the company becomes popular. And over the course of these 31 days, we'll talk more about startup investing. These are options that are available to you as we go on this journey together. So, for example, let's look at a popular company. Let's say Microsoft, for example. While the shares of Microsoft, I think the last time I checked, it was about $467 per share, and that's after several years, right? But some people invested in Microsoft before Microsoft listed in the in the stock market. These people tend to make a lot of money because they are choosing to put their money behind somebody whose idea may not have been proven yet. But when these angel investors are able to analyze the potential of this idea, then they are able to make money in the long term. All right. So we have what we call pre-seed, seed stage, and then series stage investors. So let's talk about venture capitalists. Venture capitalists are private equity investors. They form a company and seek to invest in startups or smaller businesses. And the way they differ from angel investors is that they are not trying to give money to a startup to help them get off the ground. No, they are looking at startups that have already started. They have some form of history. They're able to check, for example, if this was a startup that is developing an app, for example, venture capitalists want to look at what's your monthly average users, rate of downloads, what are you ranking in the Google Play Store, Apple Store, and things like that. So they're able to bring that to bear. All right. Let's talk about peer-to-peer lending. Peer-to-peer lending is a form of financing, beg your pardon, where loans are obtained from other individuals, cutting out the traditional middlemen such as banks. All right. And then let's talk about personal investors. These are individuals that are investing on their own, and it may take many forms. It could be they invest their own capital in other businesses. They invest in the stock market, they invest in bonds, mutual funds, ETFs. We're going to do a special episode on ETF. All right. Now, these personal investors are not professional investors, rather those seeking higher returns than simple investment vehicles like certificates of deposit or savings account. All right. So we're going to finish with institutional investors. Institutional investors are organizations that invest the money of other people into mutual funds, ETFs, hedge funds, pension funds. Because institutional investors raise large amounts of capital from many investors, they are able to purchase large amounts of assets, big block of stocks, and many times on a cheaper note. I hope this helps you. And which type of investor would you like to be? Leave that in the comments and let's know. Cheers.